Good morning. My name is Stacey Bartel, President of O.B.S Financial Services, and I'd like to welcome you back to another edition of Learn from the Tax Masters, our O.B.S Financial Educational Series. Today is Tuesday, February 26, 2019, and as we're just heading into the T4 deadline, I just want to finish up our series here talking about pay stubs. Today we're going to look at what is not deductible off your pay stub and why. Well, there's normally hundreds of deductions that you could see on any person's pay stub. We're going to cover off some of the most common ones that I get questions on from our clients. Before I begin, I just want to indicate that typically the Income Tax Act and our federal government, or provincial governments for that matter, do not give incentives for employees to go to work. So what that means is that typical costs of going to work, reporting to work every day and coming home are not deductible for tax purposes. Those costs would include transportation costs, vehicle costs, parking costs, cost of your clothes, cost of dry cleaning, cost of lunches, everything else. Basically, that's part of your obligation to get to work in order to make money, so therefore we cannot deduct any of that. So I just want to indicate that before we continue on here. Let's first of all talk about bus passes. Bus passes, well, that's a change for 2018. A little bit of a history lesson here. Back in 2007, the federal government introduced a public transit tax credit. The public transit tax credit was set up to give an incentive to people to use public transit to get to work, back from work, public transit being buses, trains, sky trains, whatever the case may be. If you were a consistent user purchasing passes of 4 weeks in a row or longer, you would be able to deduct that as a federal tax credit and get back just a little bit over 25% of what you would normally pay for it, at least here in Manitoba. However, our current government back in 2017 announced that they were going to abolish that. Now, I kind of look at this as our previous government was having us work on our environment using a carrot. Our current government is using a stick. So they're getting rid of the tax credit to incentivize people to use public transit, and they're introducing a carbon tax credit that's going to cost us more at the pump, more when we purchase retail items, more when we transport items, everything else. So we've now been hit by a stick with the carbon tax credit. We're going to discuss that later because there is some offsetting credits that come along with that. But right now there is no credit for public transit. A lot of employers will still offer you the availability to purchase your bus passes, your train passes, whatever the case may be, through a payroll deduction program. As much as it may appear on your pay stub, as of 2018, it's no longer deductible and it won't sit on your T4. Parking, that's the other big one. In major urban centers, here in Manitoba, Winnipeg, or even more so Toronto, Vancouver, Montreal, some of the bigger places, parking can be hard to find and even harder to pay for. It's costing hundreds of dollars a month. In the past, employers had looked at giving incentives to some employees, giving them either free parking or parking below normal rates. So in situations like that, what ends up happening is that the free parking or the below cost parking rates that you may be paying your employer that are subsidized, you now have to pay a taxable benefit on it. So you would see that amount in box 40. I'm going to discuss taxable benefits a little bit more in depth over the next coming days. But just to kind of give you an idea, if all of a sudden over the last year or two you started to see your box 40 increase on your T4 and you have subsidized parking or your employer takes care of your parking for you, chances are that you're receiving a taxable benefit and it's going to cost you more at tax time. Other deductions, we're going to cover a couple quickly here. Life, disability, critical illness, accidental death and dismemberment, those types of insurance payments that we make out of our group benefits policies, they're not tax deductible. Part of the reason that is that when they pay out, so if, for example, a life insurance policy, if something happens to you, your beneficiary will receive a lump sum, $10,000 up to $100,000, a couple times your salary maybe, and they'll receive that tax-free. because they've received that tax-free in being consistent with the Income Tax Act, the government won't allow you to deduct costs on things that you're going to receive tax-free. So because of that, most insurance policies are not deductible. Having said that, there is an abnormality with that when it comes to disability insurance. Disability insurance, being short-term or long-term, can be paid for in 3 different ways, just like most group benefits plans. So let's kind of recap. Number 1 is if you pay 100% for your benefits, right, for your disability benefits, should something happen to you and you put a claim in, you will end up getting those benefits 100% tax-free. If your employer, however, pays for those benefits for you, when you receive any payments from it, should you have a claim, you will be taxed 100% on the income that you get in. Now, there is one way around that, and that is if the employer is paying for you and charging you a taxable benefit. Again, we're going to talk about taxable benefits later on, but if they've assessed the value that they're paying you, let's say it's $30 a month, they add that to the value of your income. So at the end of the year, they add an extra $360 that you have to pay tax on. Then essentially you paid for it. So, but if it's not a taxable benefit, and that you'd have to check with your HR department on, if it's not a taxable benefit, something happens, you put a claim in, you're going to pay 100%. The last option when it comes to group benefits, and this is the most common one, is co-pay or split. That's where you pay for half and the employer pays for half. In a situation like that, you need to see how the disability payments, you need to check with your HR department and find out how the disability premiums are being split. In some cases, you're paying for all the life benefits and the employer is paying a majority of your health and dental, and that's how you get your split pay, or you're splitting everything down the middle. If your employer is paying even 1 cent towards your disability premiums, when and if you put a claim in, those payments to you are 100% deductible. Now, you can claim an offsetting deduction for it. However, it gets a little bit complicated, so I'm going to try to explain it here. When we talk about an offsetting deduction, what we're talking about is all the premiums that you paid into the plan prior to you claiming, or since your last claim, you're able to use as an offsetting deduction to help reduce the taxable income that you have from your disability. So, for example, if you went on disability May 1st, 2018, and you were on disability and returned to work, or you're on disability till November 30th, returning to work December 1st. Okay? Let's say during that period of time you're receiving $3,000 a month for your disability payments. Over the 7 months, you would have received $21,000. Now, let's take a look at your premiums. Let's say that you started paying into the benefit plan January 1st, 2015. You've had no claims. So because of that, you can go back all the way to January 1st, 2015 and look at how much money you paid into your premiums. So let's throw some numbers out there. If 2015, 16, and the first 2 months of 2000, or the first month of 2017, the first 2 paychecks, you were paying $25 a paycheck to go towards your disability policy. You would have had 54 paychecks over the 2 years and 1 month at $25. So that would actually be a total of $1,350 that you would have paid into your premiums. In February 2017, let's say the payments go up to $30 every pay. So from February 2017 to May 1st, 2018, let's say you had 24 paychecks. 24 paychecks in 2017, right, until present. So let's go and 24 payments in 2018, up to and including November 30th when you were off. That'd be a total of 48 payments at $30 a pop. You're looking at $1,440. So in total, let's say you paid $2,790 towards your disability premiums and you never put in a claim. Now, when it comes to tax time, you're going to get a T4A for $21,000 from your benefits provider. You will have to, now you won't get a slip or a receipt saying how much money you paid for it, so you're going to have to request this information. You're going to need copies of your pay stubs. You're going to need to go to your HR department and get a letter indicating that you paid $2,790 into those premiums. If you did, we claim that as an offsetting deduction, and in turn you would in effect only pay tax on $18,210. That $2,790 is going to save you $500-$600, maybe more depending on your tax bracket. So it's definitely worthwhile going to your HR department, getting a letter, asking them what it is. Your HR and your payroll departments are not going to be happy about it. It's extra work for them, but at the end of the day, it's worth a lot of money to you, so you need to make sure you're looking at it. Also, if you've been on disability before, if you don't remember when you came back from disability, check with your HR department or even phone your benefits provider. Ask them when your claim ended so that you know how far back you can go if you claimed those previous premiums in the past. If you were on disability and you missed those premiums that you paid prior to that one, then you can still carry them forward, but you'll need to go back again to the beginning. Anyways, with the T4 and T, that sort of ends up or wraps up our information on pay stubs. We will be talking a little bit more about them, but over the next couple of days with the T4 and T5 deadline arriving in 2 days where employers have to have them in, we're going to start to talking about taxable benefits and other things that we typically see on your T4s. From there, we're going to get into your investment interest and everything else. So we've got a lot of good information available for you over the next couple of weeks. So tune in tomorrow, and until next time, have yourself a great day. Thank you. Hello. Where's your phone?